Okay, hello everyone and welcome to this live intraday webinar. Today is March 18th. Michael Boutros, currency strategist with you guys. We are just 5 minutes away from the FOMC interest rate decision. Obviously, we're going to get the statement, guys. We're going to comb through that. We're looking, obviously, for the removal of the word patience. After that, 30 minutes later, we will go into the presser with Janet Yellen. We'll get some coverage into that as well. I want to leave the room open, guys, today as flexible as possible for pairs you guys are looking at. Obviously, on the swing side of things, sterling yen is still in focus, Aussie Kiwi's in focus. On the scalp side of things, the sterling crosses are all still in play, with the Kiwi dollar also in near-term focus. So let's jump right into the charts. We got a couple minutes before the release. Here are the last quarterly projections. I just wanted to give them up, and if you guys look in the chat box on the right, you're going to see the links there for the FOMC page and the current or the previous projections. Now, we're going to put this up against the screen here for what release in just a couple of minutes, and we'll see what the differences are. Obviously, we're going to be looking at the dot plot as well to see if there's any differences in expectations for policy firming. A quick reminder, we did see 15 members last quarter push for a 2015 hike, only 2 looking for 2016. The central tendencies as far as inflation have also been pretty steady, so we're going to take a look at that. And obviously the implications, guys, for the greenback with where we are right now. Dollar index kind of looking a little heavy here, sitting on near-term support just above that median line from the July lows. As far as the scalp setups are going, you know, the major focus has been on the sterling CAD for me from last night. I put that trade out. That one's continued to pan out. I'm flat right here across the board, guys. We were on the long side. If you remember, I gave you guys out a tweet last night about 11 o'clock as we were closing out the position just at 88.90 here. You got another stretch into that 618 before this thing collapsed on some UK data earlier today, and obviously the BOE minutes. So we're looking at this near-term support range. Really, you know, 87 gives out, and this thing is likely to find a pretty steep decline here. Near-term targets would be 86.68. and then right into the 86 handle. So we'll see if this gives us any plays here. Stefan, great to see you, says, Yo, Michael, remove patience, and what happens to sterling yen? I know, no one knows. So if they remove the word patience, it puts them on a little bit more of a hawkish stance. The implications for sterling yen might not be quite as easily playable, but I would expect to possibly see a topside pop here on some yen weakness. I'm not sure that the pound itself would per se get hit as hard, but you know, the levels are clear. I don't set any expectations, Stefan, heading into these prints. You know, the topside break above 87.90, the same level we played here, and the release is out. Looks like we're getting some initial play here. Got about a minute left. Okay, not yet. Sorry about that. Got about a minute left, so we'll keep you updated. Bring up some near-term charts, guys. Here's the 5 minutes and all the pairs I've been following: sterling yen, euro dollar, sterling dollar yen, and obviously sterling Oz. Bring up the sterling CAD as well. We'll follow that. Michael, if the FOMC is hawkish, might it strengthen the pound? No. Okay, if they're hawkish, that means they're going to move on rates. That's only going to reinforce the top side. Look, guys, we got about a couple of seconds left. I just want to say this. It's very difficult for me to see them getting hawkish here with where the dollar is. It's hitting corporate earnings. The stronger the dollar goes, the harder the inflationary targeting is going to be. So in my humble opinion, I don't think they come out excessively hawkish today. We'll have to see in just a few seconds here, monitoring the wires, and I will hit you as soon as it hits here. Good question, Sandeep. Stefan, Petro, great to see you. Thanks for the heads up, my man. All right, says remains unlikely at April FOMC, wants to be reasonably confident in inflation, median fund rates at 0.62%, drops patience. So the word is gone, Fed drops patience stance. If we look at the euro dollar, you're seeing a little bit of a limited reaction here, but the patience stance would typically be a stronger dollar play. If it sells off and we get a break of the index, which is what I'm going to be looking for, I'm not going to chase this price action just yet. We'll be looking to play that dollar conviction reversal. But until we do, watch that index at near-term support, 12,050 on the Dow Jones FXCM dollar index. More highlights. The Fed projection shows slower pace of tightening versus expectations, or the December outlook. Sees 2015 PCE inflation at 0.6%. Okay, so basically, guys, the pace of the hike, the pace of normalization is what markets are focused on at this point. We're going to bring back those 5-minute charts, and I'm going to bring up the updated assessments. This is where the tell will be, guys. So here's what we're looking at from the Fed projections at this point. Okay, here's the dot plot, guys. 15 still look to see 2015 tightening. That hasn't changed. The dot plot here is stretched out dramatically. You got a lot more at 3.5% as the normal or longer running interest rate expectation. You can see the interest rate expectation here was as much as 4.25. You only have one representative at 4.25 now. So the distribution of the dot plot is what everyone is looking at, and that's going to be a suggestion that the pace of the tightening is really not going to be as severe as quick as market expectations are. On that assumption, you would expect to see the dollar really continue to fall off here. Because although we are looking for a 2015 hike, the pace of those hikes, which is what the market has been focused on, is not going to be one of, back-to-back interest rate hikes. They're much more confident taking a slower pace of tightening. So let's go ahead and jump into the scalps that we've been looking at. Kiwi dollar, the reversal off that key support that I noted earlier today on the intraday update, has continued to gather pace. We went through 74, which was the initial target here. On a subsequent bounce, sorry guys, my computer's a little jumpy, 74.40 into 74.50 is the initial area of resistance you want to look for. That is marked not only by last week's high, but a nice confluence region here of Fibonacci levels in that 10-pip region between 74.40, 74.50, 52. That's the top side here for the Kiwi dollar. Looking at the British pound, again, not a focus on a scalp basis, but we are looking at that 48.12 as the pivot to invalidate the short side. So I'm not really necessarily interested in playing the long side of pound dollar here yet. Dollar CAD. Let's see if that reversal gathers pace. Okay, so dollar CAD also now testing near-term support. So I was actually just talking with this about this setup with Jamie. The focus for me has been on this median line right here, which we're testing right now, and also the swing low from Friday. So that takes you basically just below 26.96. On a push and a close below this, guys, you get a little bit more conviction on playing a dollar CAD reversal, which I know is something we've all been looking at here. Now, the break here of the weekly opening range you want to take in tandem with the event risk. I'm not going to really stress that that's necessarily going to be the directional bias. More so, I want to see what happens in this 27 handle here. Downside break, you're basically looking for a run into that median line, which takes you to like 26.25, 26.30 at this point. Sterling yen just popped down off the Jamie's median line and now through it a bit. Let's take a look at sterling yen. Okay, so here's the scalp setup on sterling yen. It's a little bit different. What we've been looking at here, obviously, another median line. I think this is very similar to what Jamie's looking at, but the initial opening range low, the underbelly for the week, is basically what we're testing right now. On a top side break, you're basically looking for 79 again. I don't necessarily want to press the downside here just because of what's going on in the dollar yen. I want to see this thing break 120.17, 120.80, 120.70 was it? Let me just fix that real quick. 27.50 is the near-term support I've been looking at on that. Let me bring up the scalp chart real quick. Okay, 120.55 into 120.47 near-term support. That's my concern on trying to maintain a long yen position in general. I think this is like the wicked washout trade. So I'm not really going to be a major favor of jumping into fresh yens on the back of this release per se. Dollar yen is going to be sort of a barometer for me, but I'll be watching 120.55, 120.47. You can see we dipped right into that region just now. So Stefan, as far as the yen crosses, this is kind of my barometer I'll be wanting to use. Okay, and especially because sterling yen has kind of seen a bounce, right? So I'm not necessarily sure I want to press a fresh sterling yen short from here. Again, guys, don't mix up, keep our objectives clear here. If you're in the scalp, I don't want to shake you out of that. We're speaking exclusively here for a near-term setup. Stefan, you're more than welcome. I appreciate that, my friend. Okay, so the focus again. We're gonna take a moment here, guys. We have 30 minutes before the presser. The initial reaction here is going to play out. We're going to go through the setups that were highlighted on the intraday page. So you guys have a clear setup of going into the presser is really where we can see the next surge of volatility. Obviously, the focus was on patience. Patience is gone. They've played the double card. Okay, so here's the quick interpretation of the breakdown, guys, of basically how the markets are going to take this. And again, I don't want to be repetitive, but it's the timing aspect of the pace that is being focused here. The fact that they've been able to remove the patience language and get a negative dollar reaction in the near term means they've been playing this pretty well, actually. So remember, right before the release, what we just said, it's very hard to see them be hawkish because of where the dollar is. Stronger dollar makes the inflationary target much harder, weighs on corporate earnings, and in general, you're seeing all these earnings from all these companies continue to say that they're getting headwinds from FX, that they're seeing massive drawdowns because of, you know, the underlying strength that they're seeing in the greenback. So what's the way to curb that? I think they did a really nice job here today. They're basically saying, yeah, we're on pace to move on rates. No one's changed anything. We're all 15 members still looking for a 2015 hike, but we're a little bit more comfortable prolonging the pace of the normalization process. So the focus on this being sort of the start of the underlying normalization process, yep, that could take a little bit longer, meaning we could get a 25 basis point cut you know, in June or September, and then, you know, they might wait another 3 or 4 months or even 6 months before they move on rates again. It's not going to be the start of the normalization cycle. And, you know, that's all I want to say on the fundies, guys, but that's pretty much the takeaway and why we're seeing, although the patience was removed, we are seeing a little bit of a pullback here on the dollar. I wouldn't chase it. Again, the dollar index still is going to be the focus on that 12,050 level. Okay, and as long as we hold above that near term, you don't want to get too excited here on trying to press the dollar shorts. Now, heading into the presser, here's what the focus is going to be. We're going to see what her answers are with regards specifically now to A, the inflationary picture. Remember the dual mandate, fostering maximum employment, price stability. They've labeled 2% as their CPI inflation target, and you know, we want to see how comfortable they are with what's going on in the underlying inflationary picture. Wage growth has continued to be a little bit lackluster. Obviously, retail sales and the data on the front of the consumer hasn't really been all that strong either. So if the inflation picture looks a little bit softer and she's a little bit more cautious on that front, you know, that could hurt the dollar even some more. If she sticks with the game plan, status quo, the inflationary picture is transitory, the weakness in oil prices and broader energy costs are transitory, you know, these things might alleviate some of the pressure we're seeing on the dollar here. Specifically on the language of the statement this time, guys, I'm expecting a lot of questions to be posed to her about the timing of the normalization as far as the pace. They've already offset that they're going to do the tightening, right? Expectations, like I said, on the dot plot, and specifically more so than the dot plot, where is it? Sorry, guys, bear with me one moment. Okay, so the deviation here hasn't changed. It's the deviation here has changed, and this deviation is more to do with the pace, per se, of tightening, more so than whether they tighten or not. So the pace of tightening is going to be the focal central questions that they're going to be posing to her, and based on that, I think is where we're going to get their next dollar move here. So let's jump back into price action. We will jump into the charts for the featured scalps that we've been following here. You're seeing Kiwi dollar, again, 74.40, guys, is the near-term resistance that we're looking for on that stretch. 74.40, 74.50. And in dollar yen, 120.47, 120.50, absolutely paramount level here to open up, in my mind, my humble opinion, you know, a lot more of a yen play on the long side of the Japanese yen. But it looks like the policy firming pace is really what's getting to the markets here, and that's going to continue to fuel strength in the dollar. It's tough, or weakness in the dollar. It's tough to see her backpedaling from the dot plots, guys. That's pretty significant. That's pretty significant. The flattening that you're seeing here is an underlying tell that Fed officials necessarily don't see the projected path of the economy really continuing to gather pace. It means that the expectations are starting to dwindle. Now, whether that's on the side of inflation or whether it's on the side of growth, that's what the presser is going to tell us here now. So Stefan saying sterling yen totally absorbed the pop lower than before the release. Yeah, I'm still not really impressed by it. I'm still not really impressed by it, guys. You know, you have to get a trigger on this to get us on the short side. I'm not going to press a trigger on this unless we can see, you know, a near-term reversal pattern. So here's what the 5-minute looks like. You want to be very sparing with the triggers during event risk because, again, the real kicker here, guys, the real play is still the presser. It's not necessarily this release. The language is gone. We know exactly what's going on. We see the projections. We know what they're looking for. The biggest tail or the biggest reversal catalyst risk here is if she says anything that dissuades that we're going to continue to see them basically hold the course here as far as moving with interest rates at the September meeting. Okay, so you know, use some caution there on that sterling yen there. Watch that 78.30 pop. If we do break above this, you know, I don't really want to be a part of the short side per se. I'd be expecting a run right back into 79. Okay, Stefan, just my tidbit, man. That's my 2 cents. Hi, Mike. Aussie dollar testing trend line from the highs, Gert. Let's take a quick look at the Aussie dollar. It's been a messy play, Gert. I've been watching this for a while. Petra says, better wait for the noise to pass, a much better view. Petra, I'm 100% with you. You're talking to a guy who's probably the hardest core scalper you guys know, but I don't mess with things on this in this environment ahead of the presser because you know, you can get spreads wide now. You can get her sneezing and saying some stupid comment that the markets will hang on and completely wash you out. So it's better to wait to let the dust settle unless you're taking very, very quick scalps. Now, this is the region that we were talking about in the webinar yesterday, guys, for Aussie dollar, okay? Remember, we were heading into this on the during the course of the webinar. We were looking for a downside break that materialized. You saw a tag of 76 in overnight trade, a really nice trigger break, and a break of the opening range highs shifted us back into focus. This has been the resistance ahead of this. So now that we've cleared that 77.35 into 77.30, Gert, is what I'd be looking at. It's a basic 50% retracement of the decline, the highs that you made, not only for the opening range of last week, but also the stretch high that you made there on Thursday. And that would be the initial topside objective here, constructive above this key region of support. Stefan says, appreciate it. I pay for your 2 cents. You're damn right, Stefan. Anytime, man. Trend line from 9,400 high. Let me see what you're looking at, Gert. I think you're talking about the September highs, right? That September trend line, right? So targeting that would be a 70.50 level, 77.50 rather. You know, that actually lines up, Gert, really well with the median line for the formation that we've been rallying into here. Just ahead of that, I'd still be watching the 50. Again, it's not necessarily just because it's a retracement, guys. I never just blindly follow and target retracements. Market has pivoted there multiple times. Again, the weekly highs, the stretch high, the low that you made for February on that last swing, you can see some clear pivots there. So I'm with you. From a scalp perspective, this is where I start to chip off some of that trade and bring your stops in. But yeah, you can definitely get a stretch into 77.50 for sure. Absolutely. And just for argument's sake, guys, bear with me 1 sec. I do want to take a quick look at what the extension off the lows here look like. Let's see if we made any meaningful plays. Okay, so in fact, you know, adding further conviction to the break of 76.98, basically the 77 handle, is the 618 extension off the low. You guys see that? Let's clean this up real quick. Okay. So there's a quick amendment to the levels there, 77.16 to 77, a little bit wider of a range, but you'll see here, based on where we are in time, if this takes another hour or so, basically that would be the region of resistance. I'd still start looking to clean things up around 77.30, 77.40. or 77.35, excuse me, into 38, this region right here. Not a bad pop higher. I'd be cautious. Anything above here, guys. And by the way, if you're not already long on this trade, on this breakout here, I would not be chasing this. Okay, I would not be chasing this. Wait for the Yellen testimony to start. You're likely to see things stretch into 77.40, then pull right back into the 77 handle and offer a better opportunity. So prudence pays during these announcements. And again, it's not your run-of-the-mill interest rate decision. The presser can be some treacherous waters here. So use some caution. Again, on average, just as a disclaimer, any trades that you take during this environment, typically for me, on average, will be about half to a quarter leverage of a typical scalp, at least until we clear out the main presser and the main event risk here. Okay, euro-dollar near-term resistance 107.50. Watch that very closely. Dollar-yen pressing key support 120.47, 120.50. Sterling CAD, playing that range. Major key support for Sterling CAD. So here's what it looks like on the 30-minute, guys, for Sterling CAD. This is something I've been involved in all morning and last night. So again, this is the main key support we just talked about heading into the release. Here's the near-term resistance. We tried to probe through it, but we haven't really made any progress. That's the focus as we clear out the FOMC presser, okay? I'll be looking for a definitive move sub 187. If that happens, I think there's a lot of room, okay? I think there's a lot of room. Remember the daily chart for Sterling CAD, you're testing a pretty big level here. Okay, so if that bottom end gives out, you're basically looking for 86.68, which is a soft target and the 2014 highs, but you're looking for a run into that median line. That can take you as deep as 86, okay? 86, just above 86, 86.10, 86.15. So we're going to be watching that key support here as we head into the presser as well. Kiwi dollar finding resistance, 74.40.50 near term as well. Sterling yen, looks like we're seeing the top side pop here, Stefan, so watch it on that one. You might get the recovery, okay? Remember, it came into the release on support, okay? So don't be too surprised. Don't be too surprised. 79.12, like I said, 79.27 is what I'm expecting here on this stretch. You know, that's even ahead of the release, you were seeing some divergence here, and then again, you know, I'm not really keen on going long yen as dollar yen holds support. If dollar yen breaks support, I'd be a little bit more comfortable, but you know, the yen long position for me is a weary one at these levels. Okay, so let's segue, and then we'll take a little bit more detail on all of the scalp charts. If you have any questions, guys, pairs that you want to look at that we haven't discussed yet, Yellen should be taking the stand in just under 11 minutes. We'll give you the highlights of those, and we'll definitely go through some of her comments. Petro, can you please take a look at the 30-minute euro-dollar? I want to take a snapshot for those levels. Sure can. Here's what we're looking at that, and looks like we're going to make a push right ahead of Yellen, guys, so just watch out. Here's what euro-dollar looks like on the intraday. I'll be completely honest with you. I've strayed away. By the way, guys, markets liked it, right? Markets really like it. SPOOs, really nice reversal here off of that support region, right on an outside reversal nonetheless today at this point. But looking at the euro-dollar, I've stayed away from this completely. Sterling yen, guys, initial target 79.14, 79.30. Watch for resistance here. A continuation higher, 79.80 is the next subsequent target. Remember, 40 pips per scalp here should do. I would not be initiating anything new. If we get a pullback, we'll bring up that 5-minute chart, maybe offer a better entry down somewhere near that 78.30. If we can get a pullback of that magnitude again, it's going to be hard to find topside triggers, but those are the levels that matter, and we'll continue to follow those as long as those continue to give us reactions. But the euro-dollar, Petro, sorry, I keep getting sidetracked with the sterling sterling crosses here. Okay, euro blew past it. Here's what the euro scalp looks like. So me and Jamie were actually throwing this around earlier today. We were looking at this near-term structure. I didn't necessarily want to advocate a tweet on this because of the near-term complexity of it. It looks like it, but it's a shallow rising median line formation. This is the one that Jamie was looking at. Upon further examination, it turned out to be an exact parallel for a larger formation that I was looking off of from the lows from last week, and there's the break. I mean, initial 107.50 was the initial resistance that we both talked about as possible area of entry for a possible short. We're plowing through it right now. So near term, look for that upper median line parallel to possibly offer some resistance. Really, 108.40 becomes a little bit more critical on a 50% retracement. But go ahead and feel free to take the snapshot of this, Petro, if you'd like for your own reference. Actually, I wouldn't necessarily stress this retracement's null and void at this point, but these are the operative levels I'd be looking at. He says, I did. Thank you. Yeah, more than welcome. More than welcome. I think you see 108.40 on a stretch here, at least the upper median line parallel. Dollar index, I would expect, is making a move sub 1250. There it is. Okay, so outside reversal day in the dollar index. It's going to be an outside reversal week if we finally make it below. If we make it below 11,009, what's the low there? 11,962. If we make it below that, guys, actually that matches up damn well with that former median line resistance. A break below this, you know, that's an outside reversal week at the highs at a major key resistance level would be pretty significant. We already talked about the trigger that gave out last week. Didn't really get any conviction in price action to follow through with that. Here's your 70 break in momentum and a confluence break in price. Now, I say all this as price action is developing, but the close today is going to be paramount as well, guys. If this thing sucks right back up and closes northbound of 1250, forget it. We're going to want to see the close today. GS wants to take a look at cable, and here's what cable looks like right now in the 30-minute. Okay, I would assume this is pressing the opening range high for the week at this point. Let's see where it's at. Okay, we blasted through it, 148.50, okay, and there's 148.92. So this is the region we were just talking about. You got that trendline resistance off the highs, topside breach here. You're looking for 149.50, and then right up into 150. Quarterly daily TR is only yielding 30 pips, but you know, this are the trades, guys, that you want to get in and chip away and immediately start bringing in your stops. You don't want to sit there and sit with a stop below a low and wait it out, because you're still likely to get a huge jackknife effect in the next 7 minutes when Yellen takes the stage here. So we'll look at this little pocket of resistance near term for British pound. And all that level is, guys, is just a swing low for that the low that we made last week and a clear pivot in price, right? So we'll watch that near term. Outside reversal day at the lows in the British pound as well. Look for a 40 break in momentum here to give us conviction of the reversal near term in the British pound. I'll tell you guys, I'm taken back. I think they played it perfectly. Again, I'm still kind of beside myself that they removed the word language and they softened the interest rate expectations. Is huge. It's huge, guys. It's huge, because aside from whether or not they move in September, the bigger question was the pace and whether this is going to be the onset of a normalization process where we're getting, you know, regular hikes, or whether it's going to be something much more slower, much more less aggressive. And based on the dot plot, it just shows that everyone's sliding their expectations. Everyone's sliding their expectations across the board. Across the board. You see how narrow these were? Really widened out. See how we were clustered here mostly in the 3 to 4 range? Now on 2016, we're clustered in the near 2 range. That speaks magnitudes, guys, for the expectation of where the Fed members see monetary policy moving forward. $2.3 to 2.7. That was reduced from 2.6 to 3%. Central tendency in GDP from 2.5 to 3%, 2% to 2.4%, so broader growth prospects expected to slow. Unemployment, the natural rate of unemployment is expected to be lower, which means they're willing to sit there and maintain low interest rates despite the fact unemployment is past the 5.5 central tendency that typically will be the longer running unemployment. If you take a look at PCE inflation, which is one of the major things they look for as far as the inflationary prospects, those are lower across the board, 1.7 to 2 in 2016, 1.7 to 1.9, slightly softer here for the PCE inflation. Interesting stuff, goes miles and magnitudes to speak where the Fed officials stand as far as their expectations moving forward. So that's enough of the fundies. For those of you who not really up to date with that, let's jump right into the chart. So here's what we're looking at with Sterling CAD earlier today. This was taken about 8:45 this morning. Again, we did just see a topside break of this pop. So remember the range that we were focused on is 87.90 into that key support region. Here's what Sterling CAD looks like on the 30. Okay, so it's still intact. I'm not going to call that a break yet, but with what we're seeing in the yen, what we're seeing in the pound, you might not get the cleanest move here on Yellen per se on today's event risk. More likely, you'd see this support kind of hold, maybe a little bit of a drift higher. The risk is still for a downside break for sure. And if we take a look at what dollar yen, let's take a quick gander back there and see if that support is still holding. Yeah, 147, 120.47, 120.57, still in focus here. Here's what we'll be looking at to invalidate the near-term short side. And so just as this was support on the way down, this is what we need to clear to really open the reversal play back into 189 and then right back into 189.70, the same high that we closed that long at earlier in the week. Any questions on the Sterling CAD setup from yesterday? The broader bias is the downside, but you're finding this major key support here, and we'll look for triggers on the long side above 87, depending on how we settle after Yellen. If that does give us a near-term rally, again, we'll be looking for short triggers near that 89 level on a recovery play. Moving down into the Sterling Aus. It got kind of messy, but the levels were still pretty clean. I took a flat trade on this earlier today. I actually did try to jump into the short. I kind of got shaken out because it was on a little bit more of a less conviction trigger break. It actually would have panned out to grab me at least 30 pips, but at the end of the day, I got stopped out on the break even just on a spike before we made the last move there. So I don't have anything to show for the Sterling Aus per se at this point. It's very similar setup, and then if you see that 92.50 break to the upside, we'll possibly get a recovery back into 193.60 or so. That being said, I'm weary. It's right at the same exact levels that we're looking at with the Sterling yen, just pressing the support near term. And remember, 92.11, 91.80 was huge. One of my favorite plays, 50% off the low, a 1618 off the high. Let me show you where this is from. And a very clear pivot in price. Do you see that on the January rally? Resistance, resistance, break, instant support, nice pivot range, and that's kind of where we're sitting right now. So again, I'll need to see a conviction break either back above 92.50 or to clear out that low we just made to see the continuation. Broader downside bias is still, the risk play here. It's a down trend at support is the best way you can validate it. So to play the reversal, you need a pretty compelling trigger. Similar on Sterling Key, Sandeep is saying. Very similar on Sterling Key. Here's what I'm looking at on Sterling Key. I'm not a big fan of the Sterling Key daily chart, but I am a big fan of the Sterling Key near-term chart. I think that one's pretty clear. The only level I was looking at heading into today's release here was 198.87, which is a basic 618 retracement, and then this lower median line parallel. Now, we didn't quite make it down that low. Really healthy ATR, typically a beautiful cross to play. Here's what the intraday looks like, and I think it's a little bit clearer. Okay, Yellen's on the stage. For those of you who would like to follow along, if you want to watch the conference, here is a link for you to watch at home if you'd like. I will be giving you highlights throughout her comments, so no worries on that, but just for your reference there. But Sterling Key, very similar. Yeah, Sandeep, you're coming into a major area of support, man. Again, it's that confluence of fibs. Let me zoom this out. And also the lower median line parallel for the operative trade that we're in right now. I actually strapped this on today. I just threw this together. I was showing Jamie. We're kind of both looking at the Sterling crosses, and this is one that hasn't necessarily been on focus on SB per se, but it's still testing a major key region nonetheless. Okay? You have a lot of things at work here, so bear with me real quick. I'll walk you through it, Sandeep. You have a basic median line formation off of the lows here. Sorry about the lag. Just zoom that out a little bit. Which is the primary premise that we were starting to look for a possible long entry. Then you have the key confluence, 618 off the low, a 1618 off the high, and again, a really nice pivot there in early January. Same thing we're looking at on the other Sterling cross, right, Sandeep? And that's why I think you're running the same exact risk. It's a downtrend at a major support. So, you know, we'll look to see. The only thing I don't like, again, about trying to play the long side here per se, is the Kiwi looks very good. You know, the Kiwi looks very good. 74.40 is the resistance we're looking for, and that's what we're holding for now. But on a continuation higher, it's hard to see Sterling really outpacing this at this point. That being said, I do like the support there. I do like finding a rebound off this support from here. On a scalp basis, you'd look higher with a break above that 2 threshold, that 2 handle. Okay? Why? Sandeep, it's the basic operative opening range low for the week. So I'm trying to keep it as objective as possible, irrespective. You need to see the 2 break there to give you at least a reversal opening range signal. Does that make sense, Sandeep? But very similar play. I really like the major key support here, right under 199. Actually, sorry guys, I think I gave you a dead link. Here's the correct link. Labor force participation is below trend. Some comments here from Yellen saying broader measures of job market also are improving. Yellen says labor force participation rate is below the trend. I mean, that's something that we've continued to talk about here in the room, guys. Wage growth remains sluggish. Weakness persists in broader labor market conditions as far as the underlying wage growth. Fed expects growth to support more job gains. And this is why, when you look at the dot plots, guys, they've adjusted the growth targets lower and also the unemployment rate. They're willing to sit that through lower, and the natural running rate of unemployment is expected to reduce. That's because they're going to have to keep policy a little bit tighter for longer than expected. Again, the pace, right? Not whether they cut, how often they cut, how aggressive they cut. That's what the focus has been for the markets on this release. I'm just looking at a 5-minute chart here for the Sterling Key, guys. I want to see a 40 break in momentum and a break back above the weekly opening range. From a momentum standpoint and a near-term play in the divergence that we're seeing in momentum, I think that would give us a reversal signal, looking for that rally into 20080. Remember, much wider scalp even in sterling yen. 60 pips is a quarter daily TR here. Okay, so we'll be looking for that 60 break in momentum with a push through 20 to validate a near-term reversal in Sterling Key. Sandeep says, right, thanks, mate. I will be monitoring the daily close. Right on. Appreciate that, Sandeep. Okay, moving along with the other scalp setups, I will continue to get you comments from Yellen. Says, dollars drop to mean inflation lower for longer. Says the dollar's dropped to mean inflation lower for longer. That doesn't make any sense. Sorry, correction. Yellen says dollars rise mean inflation. That makes sense. All right, looks like Yellen got caught off-handed there. So she had said that the dollar dropped, but it's the exact opposite, guys. Strengthen the dollar, which is exactly what we said here in the room right before the release, is going to continue to weigh on inflation targeting, and that's going to be a headwind for the Fed, which is why the drop of the patience and the kick out in the expectation for the pace, I think, is really a very savvy play here from the Fed. Yellen says Fed will continue to monitor inflation developments carefully. Okay, and they're talking about the unemployment rate expected to drop further than previously anticipated. And again, largely I see that as a function of they're going to have to keep, the pace of the tightening much, much slower. And again, this is going to be a positive for risk, guys. The biggest shock the markets were concerned about was a little bit more of a stern, steady pace of interest rate hikes, which would definitely weigh on the performance of broader risk assets. But the fact that they're willing to take a much more lax approach in the pace does suggest that you're likely to see broader risk assets remain well supported here. An interesting segue, guys. I do want to see what the gold picture is doing. On the back of this pullback, you'd expect to see a pretty hefty rebound off of the major key support we've been tracking in gold. Let's see if that's materialized, and it has. Near-term resistance, if you recall on the report from Sunday, we're still looking for that 72. It's right there. 1172 into 1150 was the major key range that we were looking for heading into the FOMC. This is the range we need to kick out, guys. A topside break, you're looking for a rally into, remember, it was 1185, which actually completes a basic 236 of the decline. We're going to choke that up a little bit on account of the basic trendline resistance off the highs here, maybe 1184, 1183. That's on a break of this key range of resistance into 1173, 1172. And again, if we do clear those highs, will be a nice weekly outside reversal at the lows for gold as well. So guys, heading into the deeper latter part of, the presser here, it's becoming a little bit more apparent from a technical standpoint that in fact it may charge a near-term reversal here in some of the dollar crosses. We'll have to see the close to validate that, but it looks like that is the game plan as we speak. Aussie dollar testing near-term resistance. I want to take a quick look at the Kiwi setup from last night as well. This is from earlier today, rather. Remember the support bounce, we already made 74, 74, 40, 50 is the level we just pressed. Let's see if we made it through that. Still holding that near-term resistance. 74.40 into 74.52. Yellen says rise could be made at any meeting after April. Any meeting after April is when the Fed could move on interest rates. Yellen does not rule out June rate increase. Okay, so guys, there's going to be a whole lot of posturing, a whole lot of fluff going on from her here, as we usually do get as a normal occurrence on these interest rate pressers. Listen, I think the gist of the meat of what we're going to get is here now. If we would have seen her start to backpedal a little bit and soften that tone, still looks like they're pretty steadfast. The question and answer section in just a few minutes is, I think, where we're going to get a little bit more of a tell on where they stand as far as the inflationary targeting. They've already noted that a stronger dollar is going to keep inflation lower longer than expected, and that is the major caveat here that's going to allow them to really take a much more backseat, slow approach to normalization than the markets were initially anticipating. All right, so sterling or Kiwi dollar at resistance. I will continue to watch this. It might actually offer a decent pullback here if you get a near-term trigger on the 5. I kind of still want to see what happens as far as clearing out the Yellen event risk right here. Not something I'm going to ever do. Try to press a trade while this thing is in overbought condition. Those are conditions that can last indefinitely. And again, you're fighting the broader directional momentum here if you do that. So nothing here on tap that's really necessarily prompting action on the short side of Kiwi just yet. Euro dollar. That level of resistance we highlighted, 107.50, now offering some support on the pullback. Remember, this is what the euro dollar structure looks like on the 30-minute. And guys, I'm just jumping from pair to pair to keep update with what's going on across. If there's something specific you want to look at, if I'm going too quick, please feel free to stop me. Okay, and again, remember key resistance here near term for the for the euro dollar rather, right in this little section just below 108.30, 108.40. Okay, so just some more comments here, guys. Listening to Yellen, she's saying if inflation does start to move more towards the glide slope that the Fed was initially looking at, that the pace could change to reflect that development in the economy. These are all this is all nonsense, guys. These are all just not backpedaling per se, but padding the initial comment here. I think the meat of where they stand is pretty much out. Yellen says residual effects of the financial crisis is a restraint on credit. Okay, and now opens up the Q&A section. Let's see if she gets anything. Let's see if she gets any curveball questions here. Again, we'll be looking for concerns about inflation, and now that we've got the release, strengthen the dollar and how that impacts it. Let's see how she responds. And it looks like dollar yen with a messy defense of that 120.40, 120.50 region. You know, it stretch as low as 120.33 here, but it looks like that's still the region to beat on the short side for the dollar yen. And accordingly, sterling yen, right, still holding at the highs here, not seeing any pullbacks from there yet. With that 70 breaking momentum, the 5 minutes to possibly set things off for the sterling yen. Let's take a look back at where the intraday is. Actually, it might be a nice pocket of resistance here. Okay, so Yellen just making a point that they continue to project growth in the in the labor markets, an improvement in GDP, but at a slower pace than earlier expected. But still consistent with moderate growth. So nothing there that we can take away necessarily from any tells. Petra saying, if the dollar closes below support, what would be your favorite pairs to play the correction besides Kiwi dollar? Good question. Good question. If you're gutsy enough, guys, you know, I really like the Kiwi setup more than anything. The dollar yen, I was much more interested in playing the short side of 120.50, 120.40 gave out, because I think this is another trade that needs to alleviate just some of the massive upside that we've had. Excuse me. And on the back, specifically of the ridiculous opening range that we've had for the week, even heading into Thursday, I would have expected this yield to give us a much more precipitous decline. So on dollar weakness, this was actually a favorite play of mine. Now that we're holding 120, I still think you need to pick your entries a little bit better, but I still think the downside here is actually pretty good in general on dollar weak plays. The dollar CAD correction is something I would be cautious on. I think it materialized very well just in general on the reaction that we're getting. But to be quite frank with you, Petro, I'm not really crazy about the dollar crosses. You know, I haven't been writing about them lately. It's just not, you know, it's not as clear for me on the intradays for as many of the dollar crosses as we'd like to follow. I mean, Kiwi dollar is still going to be the preferred setup. Like I said, dollar yen on a break of 120.50, I'll be much more happy to play that. But here's what I'm looking at with the dollar CAD. We looked at this chart just a couple of minutes ago, guys. This is that median line. There was the break of the initial support structure that we were concerned about, 126.90, and look where we found some support right here. So again, chasing these moves after the release has not been a fruitful play over the years, guys. Okay. In fact, I wouldn't even be surprised if all this stuff reverses and we close right back unchanged on the day. And also in such a scenario, Petro, instead of the crosses, if I can divert your attention, gold. If that thing tops 72 on a closed basis, I think you play the recovery. There's not a damn reason not to. That was a huge region of support. Remember, aside from that daily chart, which we've been following like glue for the last 6 months, the weekly chart for gold is kind of the thing that I've just been staring at. And I've had that on the intraday page for you guys for a while just because of the significance I think it holds with this region. That's silver, actually, which is very similar. But here's the gold weekly. 1137 into 1150 was just an absolute huge region of support. So on a close below support in the dollar, and specifically if we kick through 1173 here, 1172 on gold, I think that's another play we'd be liking, or we'd favor the long side near term, right, on a scalp basis. Okay, so they're questioning her on the fact that the forecasts have been lowered, and is that a change in the Fed's outlook, or that is a change in the Fed's mentality on monetary policy? Okay, she specifically is noting inflation here, guys, one of the main things that has caused them to reduce their interest rate forecasts for the longer running period. So where interest rates will be in a year from now is lower. One of her major concerns, or one of the major things she just said, was the fact that inflation data has continued to remain rather subdued. And she's padding it by saying, yes, in inflation, we are reducing, and the GDP has targeted lower, but also you have to take into account that we're seeing a continued downward adjustment to the longer-run unemployment rate as well. So she's saying that we're going to continue to expect the economy to gather pace, although at a softer trajectory than expected. So guys, I'm going to let you guys sit out the rest of this and go through her presser. I really, honestly, I don't think that we're going to get anything from her that's going to shift what the market has taken away, which is we are already on pace for a 25-15 hike. The pace and magnitude of those hikes is likely to be much more gradual than the market expectations typically have been. And that's not only on account of softer inflation, but also on account of the stronger dollar and expectations from the majority of Fed members for not only slower growth than expected, but also slower inflation moving into deeper in 2015. I'm going to open the floor just one more time, guys, for questions from you. If there are any other pairs that you'd like to review. We've gone through everything on the scalp page. Sterling Oz is the only one that we didn't really go into in detail. And again, on that trade, just to give you a quick update, by the way, the gold trigger that we've been watching for a while also looks like it's going to give out today. This trigger means nothing, by the way, unless price is maxing that 1268 target to the upside. So I just want to note that as something I'll be looking at. But Sterling Oz, as far as that setup is concerned, looks like this on the 30-minute. You know, it's very similar to the pairs that we just talked about in that the pair is coming into support, and the focus is going to be on whether we make it out 91.85, the underbelly of that or not. 92 into 91.85 is what I'll be watching. Again, do you see that dark median line formation? Oops. Let me just let that snap real quick. That's the bearish invalidation level that we need to get through. And if you notice that dark line, it actually is going through the highs that we made just last night. Okay? So basically on a topside break above 92.50, you're looking for a possible rally all the way up into 93.60 here, 93.80 on a stretch for the upside for Sterling Oz. In confluence with this, we'll be wanting to watch what the Aussie dollar does, right? That kind of made a nice move here just now as well. Now testing near-term resistance, and again, as we said earlier, the paramount level is 77.38, 77.40. Nice area of resistance that we just ran into. All right, so guys, we will pick things up bright and early tomorrow morning for one last intraday strategy webinar before the end of the week. We'll be covering the aftermath of what happens here today. Again, all the intraday charts were updated ahead of the FOMC print, guys, so all those levels are active. I will give you an update later tonight. It's likely to be a little bit later than typical. Me and Jamie have a little trip to do here together today for some business, but definitely we will have that out for you later in the session. As always, we'll keep you updated on SB Squawk. Best of luck trading, guys. Listen, let it settle out. I don't think you're going to get anything new beyond what we've gotten from Yellen. On the stretches here, watch for some exhaustions heading into Asia and then a possible continuation of a lot of these trends in the Asian sessions. The reaction in the overnight trade session a lot of times can be just as playful and just as opportunistic as what we do here during the actual release in the U.S. So we'll be looking for the Asia Open. We'll be looking for the Asia Pac Open into Europe specifically to get a little bit more directional guidance on whether we should be looking to fade this move on some of these dollar crosses. And again, obviously the obvious conviction here is we're going to be looking for that dollar index to see if we close sub 12,050 on the day. Best of luck trading, guys. And we will see you tomorrow morning, bright and early, on the Intraday webinar. Cheers.